Hey everybody, this is Coach D here with TackleTrading.com, and I put out a video about 2 years ago on deep in the money options, and I just got a question on it just yesterday, and I think it's a great question that I thought we would answer. But before I do that, I just got to show you how awesome this video is. Let's maximize that. Hey everybody, this is Coach D with TackleTrading.com here to talk to you about what are deep in the money options. Getting pegged in the back of the head right there by a little fallen money cash flow. Now, I'll spare you the rest of the video. You can watch that one on your own. Deep in the money option has a strike price. I'll go ahead and stop that. Okay, so let me actually go down here and show you the question that came in. And it came in from, not sure how to pronounce that. We'll go with Sheik 711. And let me zoom in on that so we can read it. I've been trying to understand option trading recently. And one question I have now is, let's say XYZ is trading at $10 a share. Now, let's say I say the stock will go up and I buy a call option, let's say 30 days out. So that gives you just 30 days for the stock price to move. And when I see call options, for example, the $15 strike price on the call option is about $5. Well, there's a clue. If you're paying $5 for a $15 strike price, you are paying a lot. That shouldn't be more than $1.50 on the call option, because it really shouldn't exceed more than 10% of the stock price. It should be more like 5% of the stock price. So it should only be like 75 cents. But that means those options are overpriced. And then here it says the call option is $5, but I see the $50 strike price. That's 35 points out of the money, and it's only going for 20 cents, hypothetically. Well, that's cheap. And the odds of the stock price getting out to 50 are going to be really, really low. So, yeah, sure, it's only 20 cents, but it's like buying a scratch-off ticket for the lottery. Yeah, it doesn't cost much, but your odds of winning are not very good. So that's the problem with buying out of the money options. Now, there are times you can buy out of the money options, and there's some rules I can give you to help you consider that. So again, let me finish reading this. So why shouldn't I buy the $50 strike price option for just 20 cents? It's cheaper. I know the stock won't go to 50, but I can still sell my call option when the stock hits 15 and make a profit. Maybe you'll make a profit. You're not considering time decay, volatility shifts, and just, again, you're not getting a good bang for the buck on that option. I'll show you why. The only difference is you pay $20 instead of $5 or $500 for the call option. So what are you missing? Why shouldn't I buy a very high strike price option for cheaper? What are the disadvantages? Okay, great question. So if we were to go find a $15 stock that fit the bill, let's go see if I can find an example of this. I'm gonna go to our options report for this week, and let's go see what kind of stocks we have on the list that are cheap. So let's see, $15 ballpark, so we can get an equivalency here. We've got Snap for going for $20. That'd be a pretty good equivalent, not quite $15. Or we got MGM for $19. I could do the MGM for $19. That's probably a good analogy here for us. So let's go talk about that. MGM this is, again, decent little swing trade setup. So let's go take a look at MGM. So I'm going to open up Thinkorswim. I'm going to type in MGM. And let's take a look at the stock chart here. So what we would like about this trade, and this is realistically, a chart setup where we've got a pullback. The stock rose up to a recent high, pulled back down into a known support resistance zone, rising 20-period moving average, and there's a bullish engulfing candlestick. And it would be realistic to expect this stock to rise from the current price of 19. Probably the realistic target here is that 200-period moving average, 24. So it might rise up to 24. And if you look at the stock's history, that would take about 1, 2, 3, 4, 5, 6, 7, 8. That's 8, 9 days. That's 2 weeks of trading. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. That's 2.5 weeks of trading. 1, 2, 3, 4, 5, 6, 7, 8. So your time estimate on this is 2-3 weeks. So you could buy a 30-day out of the money option, but there's a problem with it, and I'll show you that. I'm going to go hit this trade tab here, and we're going to look at the MGM options. We have lots of options to choose from, anywhere from 4 days out to January 21st of 2022 with 585 days. And if you're buying a short-term option, that means you're a short-term trader, probably no more than a swing trader. And if you're looking at, one of the tricks you have to understand is you have to understand two things, delta and probability. So I'm going to grab my drawing tool here, and I'm going to highlight this for you. So I've got this set to show me the delta, gamma, theta, and vega, and this is the call side. So I'm on the left side here. We're looking at the calls. There's the delta column, and these are the strike prices. Okay, so the in-the-money options are highlighted in blue, or whatever color you want to call that, periwinkle, I don't know. And the out-of-the-money options are in black. And if you were to go buy an out-of-the-money option that's cheap, that only costs 20 cents or so, well, that would put you clear out here at this $30 strike price. So you got a $30 strike price. I mean, the stock is currently trading at $19.67. $30 is way out there. The options would cost you 25 bucks or so. So you could buy that for 25 bucks and 24 bucks. All right, okay, cool. All right, so now it's only $24, and I'm just going to go ahead and hit confirm and send and buy it and just show you what some of the challenges are with that. And that may take a minute to get filled. While I'm waiting for that, I'm going to go analyze it. Okay, now, first problem you're going to run into is this option will have low delta. And I'm going to, let's see here, I've got some couple settings here. So these options expire on the 18th of next month. So those expire again July 17th, that's the expiration date. So 17th, 18th is when they actually would get assigned. And this is how much time you have to expiration. And if I set this calendar down here to today's date, then what you'll see here is this light gray area on the chart is what's called the standard deviation. Odds of probability the stock price will not escape this light gray area. And that's pretty cool. You're like, awesome, I could buy it for 20 bucks. And if the stock price rose up to 22, 23, 24, 25, if it rose out to 25, you'd make 110 bucks. That would be 5 times return on your money. That'd be awesome. 4 times return on your money. That'd be solid. So, okay, now we got filled. I'll go ahead and take that out. And I'm going to show you something that's super important. When you look at the trade tab and you look at the delta column, this delta tells me 2 things. First thing it tells me is how sensitive the option premium is to the underlying movement of the stock price at the rate of $1. So basically delta, which is this little triangle symbol, delta times $1. That's how much you would get if the stock price moved $1. So that's 0.09. So if in theory MGM moved up $1. So the stock price went from 1967. It went up, so I'm going to draw it up here. It went up to 2067. That's plus $1. You'd make 9 cents. The stock price moved $1 and you only got 9 cents on the dollar. That means that that call option is lazy. It is lazy. It's not working hard. Your stock's working hard, but your option's not. And you'd make $9, but you're not accounting for the time decay. It would take probably 2 weeks to get out there. So watch what happens when we factor in the time decay and what's put in our profit target. So here, that 200 period moving average is at 25. The odds of it going past 25 are slim. Slim. So let's put that ballpark target at 24. So I'll set this little slice out here, this little price slice. I'm going to drag it out to 24. And if it ran out to 24, today, if it ran out there today, you'd make 78 bucks. That'd be a 3 times return on your money. That'd be cool. But you're forgetting about time decay. That would take probably 2 weeks. So I'm going to take the calendar down here at the bottom and march it out here 2 weeks. Today's the 15th. That would put us out, say, to the 29th. Okay. It runs out to 24 and you'd make 25 bucks. You would make 100% return on your investment, assuming you sold it and it ran up in, 2 weeks to the 29th. 15 days, that's, might be a little bit more than 2 weeks in trading days, but not much. And you'd make a decent return, but the probabilities, that would require a perfect outcome. It would have to rise all the way out towards 24, 25, and you'd be out there and you'd be like, okay, boom, you doubled your money. Awesome. The probabilities of it expiring in the money are only 9%. And another way of thinking about delta is it's not only how sensitive the option premium is to the movement of the stock price, it's also a probability. So if that's 9%, that means there's only a 9% chance that the stock price will expire in the money. That means that there's a 91% chance it expires worthless. If you want to buy that option, I'll actually sell it to you. I'd be glad to sell it to you because I'd have a 91% chance of keeping your 25 bucks. And you would have a 9% chance of possibly making some money. You might get lucky. Now, I have a personal rule when it comes to buying out of the money options. The delta cannot be lower than 25. So everything from this strike price down here, from the $25 strike price down, that's out. Because those have such low probability of occurring. It's all extrinsic value. Let me show you this. I'm going to switch the view here to what's called extrinsic value. And that, well, let me change it here. I'm actually going to go show probability. I changed my mind. Let me go show you probability. So probability expires out of the money, and delta, there's a 94% chance that option expires worthless, 93% chance, 92% chance, 90% chance. And you'll remember my cutoff was about 25. We wouldn't buy anything past 25. And so we'd have at least a 20% chance of winning, 80% probability out of the money. That starts putting the odds in my favor. If you started buying lower, you'd have 76% chance of it expiring in the month, or 76, so you'd have 25% chance, 71% chance. You'd have almost a 30% chance. So probabilities. Now, let me take it back to the delta. This is sensitivity to the stock price movement. So again, this is, it has to be above 25, so it has to be above that yellow line. And I could buy this 24 out of the money. I like to buy, my personal rules, delta of 30 or higher. So the only option I'd consider buying on here, I'd buy the 23. And if I did that, I'll go ahead and buy that one right now and show you that. And again, I'm doing this in a virtual account just to show you. So let me just go click on the buy button here. Let's go to the trade tab, July 24, delta 32, 23. Okay. Boom. I can pick that up for $1 even. Awesome. Oh, 99 cents. I'll take it for 99 cents. See if we can get filled. Okay, 99 cents. Let's see how long that takes to get filled. I'll analyze that while we're waiting, and we'll talk about the same outcome. What if the stock price rose to 24 by 2 weeks from now? It doesn't. Want to come say hello? Come say hello to everybody, buddy. Come here.
First you had to give me the salad.
No, I don't have to do that. But come here. Tell everybody here, say, don't buy out of the money call options.
Don't buy out of my call options.
Because it's a sucker's bet.
Because it's a sucker's bet.
That's right, sucker's bet. Okay, give me a high five. Okay, now let me finish my video. Okay, go. Bye-bye. Yeah, you gotta go. Bye-bye, I'm making a video. All right, back in business. Where were we? I was going to show you how the $23 strike would act. Now, you'd be putting $100 in, and if the stock price rose out to 24 in the same amount of time, 2 weeks, so that puts you out again at June 29th, your rate of return would be about $140. You'd make 150% return on your money. That'd be awesome. The time decay won't hit you quite as hard. The delta works harder for you. And actually, this stock, my rule is it has to have a delta of 30 or higher, and the strike price has to be able to move in the money. It has to be able to get to 24. You can't buy a $50 call out of the money. You can't buy a $30 call out of the money and expect to make a dime. Odds are you will lose. Now, if you treat it like a scratch-off ticket and recognize, yeah, it's cheap, you won't win very often, but when you do win, you'll win a lot. There's better ways to do that. Something you could come learn from us that would teach you how to make cheap speculative trades would be like butterflies, and Coach Gino could show you how to do that. If you come hang out with us in the lounge, become a Tackle Trading Pro member, you could crush it with having very nominal risk. But buying out of the money call options is one of the reasons beginners lose money, and they lose money consistently, is because they think, oh, they're cheap, I don't have a lot of risk. Well, you don't have a lot of probability either. So when you buy call options, couple good rules for you: never buy deltas lower than 25, preferably 30, and always buy options that have the probability from being able to move from out of the money to in the money. So in this case, if we saw MGM rise for 2 weeks, it could actually get there. That's within like a typical swing for this stock. It could cover the distance in a short period of time, but it's not going to get to 30. There's statistically, you would have to see a miracle for that stock to get to 30. And yeah, you could buy and maybe double your money, but you'd actually do better buying a stronger delta, 30 or better. 35 is a sweet spot. 40 is a sweet spot. Some traders like to buy at the money. I don't particularly care to buy at the money because you pay a lot of extrinsic value. And I would actually say either buy short-term out of the money, like, delta 35 or higher, or you could buy deeper in the money options, delta 60 or higher, with less extrinsic value. So this is Coach D with TackleTrading.com. I hope that explanation was sufficient enough for you. And if not, just come spend more time with us over at tackletrading.com. Hit the like and the subscribe button. We'll be putting out videos like this periodically, a couple times a week. And then, of course, we're doing live content every day of the week with our halftime report. And then we are, of course, teaching people how to trade. Come be a pro member. Try it out for 15 days free. And see what you like about it. You'll learn a ton. We have courses on options that'll prevent you from making dumb mistakes.